US government debt has just hit $35.3 trillion and is escalating at such a rapid pace now that we will see $1 trillion of new debt being added every 90 days, a truly eye-watering speed. This now puts total public debt as a percentage of GDP at 122% and federal debt held by the public as a percentage of GDP at 97%, with both of these numbers only continuing to get higher over time. There are many consequences that come from a rising debt pile, and with the situation only getting worse by the day, many US citizens could soon be feeling the pain one way or another. And numerous financial institutions and prominent figures are now sounding the alarm, believing that we are on the pathway to a disaster unless something is done about the situation. Under current policies, the Congressional Budget Office is only expecting these debt to GDP ratios to get higher, projecting government debt outstanding to balloon from 100% to 200% of GDP over the next 30 years. We are already pretty much at all-time high levels of debt relative to GDP, only being beaten by the post-World War II era in the 1940s, so if the ratio does indeed rise to 200%, then we would truly be in uncharted territory at levels far higher than we have ever seen before in history. The problem stems from the US government spending more money than what they are generating through tax, leading to a budget deficit that has to be accounted for by borrowing money. Now, these budget deficits have been on an upwards trend over time, and in fact we have not seen a budget surplus since 2001. What's even more scary is that the CBO are projecting yearly budget deficits to continue to get bigger and bigger over time, reaching a staggering 8.5% of GDP by the year 2054. As a result of this debt increase, the US government is now spending $3 billion every single day on interest expenditure. Now, this is double what they were spending pre-pandemic and 3 times what they were spending throughout the majority of the 2000s and 2010s. And these debt servicing costs now make up 12% of the government's total spending, which is expected to only keep growing and reach a staggering 23% by the year 2053. And as a percentage of US GDP, this is expected to reach close to 3.5% by 2025, which is around the same level as the highs that were seen in the 1990s. Now, obviously, a soaring debt pile is one of the reasons why these debt interest payment costs are so high. However, another contributing factor is the average interest rate which is being paid on this debt. Now, this rate has been climbing due to how much the federal funds base rate has risen over the last few years and has now reached above 3.3%. One big problem is that $9 trillion in government debt is maturing over the next year, which will all need to be refinanced at current interest rates, which are all currently higher than the 3.3% average, no matter what the duration is. This means that the average interest rate on this government debt pile is likely to continue rising over time, even though baseline interest rates may soon start to come back down a little bit. In fact, markets are pricing in US rates to bottom at 3% before gradually rising upwards for the foreseeable future, meaning that we are unlikely to ever get close to the rates that we saw for the majority of the 2010s, barely above 0%. And as a result of all of this, the CBO is forecasting both 10-year Treasury rates as well as the average rate on the whole debt stockpile to actually only decline by a very minimal amount over the next few years. And in the long run, up until 2053, the CBO is actually forecasting rates on both of these to gradually tick upwards to be higher than they are in this current moment in time. This really does paint a grim picture for the US debt situation, as rate cuts later this year are not a get-out-of-jail-free card, and there really isn't any easy way out of this situation. But this is just the beginning of the US government's debt woes, and things could get a whole lot worse looking at some of the concerning trends that are taking place in the debt marketplace, a crucial component of the government's debt issuing ecosystem. Now, the amount of new debt needing to be taken out by the government is rising at such a pace that auction sizes will be increasing by 27% on average across the different durations compared to in 2023. And the shorter durations of 2 and 5 years are seeing their auction sizes grow even more significantly, both over 50%. Now, looking at the rise in auction sizes over time, we can see that there wasn't really any growth throughout the 2010s, but since 2020, the size of government debt auctions has gotten considerably higher. And as a consequence of this, we are starting to see the bid to cover ratios of these auctions steadily fall lower and lower, which is a sign of demand weakness. The bid to cover ratio is the dollar amount of bids received in a Treasury auction versus the amount that was actually sold. So a higher ratio is a sign of strength, and therefore seeing this ratio gradually get lower and lower is not a good sign for investor sentiment and appetite on new government debt. Also, of all of the new Treasury debt being auctioned, Treasury Bill issuance has been rising more so than any other type of Treasury debt over the last year or so, and with it has come a growing T-bill dominance. The problem here is that we normally see this pattern of large T-bill issuance take place during a recession, as this happened in 2008 and also in 2020, so the fact that bill issuance is surging now is not a good sign and is a signal that a recession could be imminent. Meanwhile, the Federal Reserve is continuing with their quantitative tightening process, meaning an additional load of supply of treasuries will be offloaded onto the market from this, on top of all of the fresh debt from auctions that we have just discussed. What's even more concerning is that we are seeing foreign central banks quickly lose their trust in US debt and are not only pulling back on their spending on new US Treasury debt, but are also in some cases actually offloading their debt piles and are becoming net sellers. Here we can see the foreign holdings of US Treasuries as a share of total debt has been declining since around 2015. China is a big one, as they are one of the largest holders of US Treasury debt, but have been net sellers for a while now, with the pace of this selling only getting quicker since 2020. And Japan has also been gradually reducing their ownership of foreign debt securities since 2020, with a potential $400 billion fire sale of US Treasuries coming up soon to help prop up the value of the Japanese yen. The fact that selling from China started to escalate at the same time that US national debt started to skyrocket is probably not a coincidence, and is a sign that many foreign investors, including global central banks, are losing confidence in the US financial system and believe that the risk of owning US debt is getting higher and higher. We're also now seeing that even US households who had been big buyers of US Treasuries when rates were getting raised are now scaling back their investment too. With the supply of new treasuries rising, while the demand is dwindling with some large global players actually becoming net sellers, Wall Street veterans like Jamie Dimon and Ed Yardeni fear that investors will begin to demand more interest to compensate for the increased risk. This would of course make servicing the national debt even more costly for the government. And as a result of this ever-climbing spending on debt interest payments, we could see the US government be forced into making major cuts to the largest program on the budget, Social Security. A recent report from the CBO did suggest that without some sort of reform, the Social Security trust funds will soon be depleted and unable to pay full benefits. This includes funds that provide benefits to retired workers, disabled workers, and the families of deceased workers as well, being depleted by the year 2034, which would cause a 23% cut to all benefits. Now, this is partly down to the ratio of workers to Social Security receivers continuing to decline, causing the gap between revenues and outlays to get wider and wider into the future. However, the ever-growing expenditure on debt interest payments that the US government is burdened with means that there is very little room to manoeuvre in the budget to help out with the Social Security program. The debt situation is really becoming so bleak that people and institutions are starting to speak out publicly, including the CEO of Bank of America, who recently called on politicians to address the situation sooner rather than later. Earlier on in the year, he did also warn it was past time for lawmakers to get the US on a sustainable fiscal path. And JP Morgan's CEO, Jamie Dimon, did also speak out at the beginning of 2024, comparing the government's surging deficit to running 60 miles per hour towards a cliff, warning the US faces a global market rebellion if lawmakers don't change their policies. One other area of concern is the fact that the US dollar has lost a lot of value over the last 6 months or so, and could continue to decline as more and more global central banks are losing faith in the US financial system and are looking to move away from using the US dollar, all of which could only exacerbate the current government debt crisis. My previous video goes into more detail on this topic, and you can check it out by clicking on screen right now. Aside from that, if you did enjoy the video, please be sure to leave a like and subscribe, as that does help out the channel a lot, and thanks a lot for watching.